Hi everyone, and welcome back to my segment on StockCharts Mish's Market Minute. I once again would like to thank the team of StockCharts and all of you for watching. I really appreciated the comments that I got last week. So let's go on. We have a lot to cover. Let's start with the agenda of what I would like to cover for you today. So as I had mentioned to you last week in my launch, everything in life is about relationships, and certainly that is the case in the market. We certainly saw a lot of those relationships change dramatically over the course of a week. So today we're going to examine those key relationships, considering the Fed's increasing role to bolster the markets. And the relationships I want to go over with you are the credit markets, the economic modern family, the US dollar and how it will relate to commodities, and then value versus growth. And then a last word about what could possibly go wrong. So let's get started. So the first thing I'm going to talk about with you is the relationship among the high-grade corporate bonds, the junk debt, the treasury bonds, and how the Fed absolutely went wild. Today, after the, actually Thursday, after the unemployment claims came in very high at 6.6 million, the Fed immediately injected another 2.3 trillion into buying bonds, which included junk. That was something new for them. So basically what the Fed has done is bypass the Federal Reserve Act, which means they can pretty much buy whatever they want. And equity ETFs could be next if they haven't already started. So the idea that they had was to aid small and mid-sized businesses as well as state and local governments, according to Powell. But that makes us wonder what happens to those businesses that they're lending money to and giving loans to when they go out of business. Then the US investment grade bond ETFs right now have been flooded with money, so much so that the total assets have surged 50% in less than 3 weeks to a record $41.6 billion. That's all the Fed. And the junk bonds, or the lowest investment grade bonds, were bought in a fire sale to try to prevent what JP Morgan predicts could be $200 billion of debt of the fallen aging companies like Ford, which last week was downgraded to junk. So let's take a look at a chart. So when we're looking right now at all of the weekly charts here, let's take a look and see what's happening. So here's the LQD. This is the high-grade corporate bonds. This is really the one that the Fed has really given a lot of money to. So looking at this right here, what we can see is that after the big crash this week, it just has ended back up into a bullish phase. So that is a lot of activity by the Fed. And of course, it shows that what they really want to do is no matter what, make sure that these high-grade corporate companies remain solvent. Then over here, we have the junk. Now the junk, that is the lower yielding companies, and they once again came in today and bought some of that. So also last week we had talked about the inside week and that this had to clear over the high. Well, it more than did that handily today. However, do note that now we're heading into some resistance here as we get to both the 50 and the 200 week moving averages. And in every chart it'll be consistent. The 50 will always be depicted by a blue line and the 200 will always be depicted by a green line. So you can see where most of the money is gone, and now this is starting to play catch up. So HYG is a combination of both high yield and junk. So right now that too has gotten a lot of money in, and again, just like with the junk, had an inside week last week, and this week has exploded very, very much over that inside week range. And of course, as we can see now, is getting close to its resistance levels up here at around 86, or where you're seeing a death cross of the 50 below the 200. And just for comparison's sake, this is the TLT. So these are the treasury bonds, 20 plus treasury bonds. That is still holding on a bullish phase. Here's your 50, here's your 200, and this is your 10 week. And so essentially what you have right here is still a range very much happening, with a range here between 160 and 170. And so that too is going to be an interesting thing to watch as we start seeing how things play out next week. So now This is another way to look at this. I had shown this chart to you last week, and when we talked about it, essentially what we talked about was how does these high-grade bonds compare to the TLTs or the Treasury bonds. And when we looked last week, if we start here at the bottom, what we saw was that the shorter-term moving average, it was still below. It was touching up against it, but now, of course, you can see that it has exploded through it. Now, that doesn't mean that it still has that it's now a new buy from this point. All it means is that we could see a move up to the next resistance, which is the longer term moving average. And remember, I had pointed out to you that this ratio was starting to flip even as the SPY and the Qs were making new highs. So now we'll see what happens here when it comes to what the bonds do versus what the high grade does. Now, if we look at this chart right here, this is actually our real motion indicator. And by the way, I want to say that we are going to eventually switch to StockCharts format, and we're going to put all our indicators there, so that will be something that we'll be doing soon. What you can see with this is that the momentum has definitely flipped back up, but again, right into the resistance here at the 200-day moving average. And so this too is going to be something interesting to watch as we go into next week. And of course, what we can see here on the daily chart of the LQDs is that we have strongly moved with a gap today over the both moving averages, and the 50 is still below the 200, so that makes that an accumulation phase. And of course, if we get some kind of golden cross, it'll be in a bullish phase. So what we want to watch is whether or not the momentum is telling us it was overdone, or whether or not it's just getting started, and the same thing with the ratio. Excuse me. The next thing I want to look at with you is that economic modern family, or the inside of the market. We saw a tremendous amount of rotation today. I'm going to show you the charts a little differently than what I showed you last week. So we're going to look at it in two different slides. The first slide is XRT, which is the brick and mortar retail, then the transportation sector, IYT, and then IWM, which is the Russell 2000, or the manufacturing. So what we want to really look for here is what happens with rotation. So essentially what we're seeing right now is that in the IWM, we actually have gone back over. This is our triple play indicator, and what it does is it compares the ratio with the SPY, with the SPY. And you can see that right now that has flipped positive, and same thing with here in terms of the price performance. This is the volume performance and this is the price performance. So that's why you saw some money rotating, and percentage-wise on Thursday, the IWM closed over 5%, where the other indices did not close as strong. So why? Why? It's very simple. It seems like all of that junk buying that the Fed has done will impact a lot of the companies that are in the Russell 2000 and in the manufacturing sector that have been suffering even long before the virus happened. Now, if we go to the real motion indicator here, the momentum has flipped, but again, it's going to run into resistance. And of course, if we look at the daily chart, we cleared that inside week I was showing you a week ago. We got over 120. We actually filled a little gap here. So now it's going to be interesting to see whether or not this holds 120 or continues to go up to, say, stronger resistance up at the moving averages at around 137. If we move to IYT, transportation, there is a lot of buzz right now about infrastructure fundraising that has been increasing in the private sector, with Brookfield Asset Management actually raising $20 billion during the first 3 months of 2020. And that's really, we're talking about not so much FedEx and UPS, but more like the water lines and the air traffic and the roads and the bridges. There's been talk about infrastructure improvements for a very long time. So I would be very interested to watch this sector for many reasons. It's a very important sector in the economic modern family, being the demand side. And you can see on the daily chart, we did clear the 10. We still have a lot of overhead resistance. We're in a bearish phase. If we go down to real motion, again, the momentum has switched, but has a lot of resistance overhead. And what's interesting in the price, which is the price of IYT versus the SPY, we have not flipped like we did in the IWM. So this sector is still lagging. In volume, we did very, very well. Now, if we move over here, which is XRT, which is the brick and mortar retail, that too, of course, made a move along with everything else. Similarly, the real motion has flipped, but getting into some resistance, which will also correspond with the 50-day here up around 37 if it gets up that high. We did start to outperform a little bit on the SPY in terms of price and a little bit on the volume. So really these three are going to be very key. This, can it get through the resistance? This, can it start outperforming the SPY better? And of course this, if it can just keep up, good old granny. Now let's go to the other three sectors. Now we'll start over here. Now interesting, you can really see the difference in terms of where money rotated out of, and that's in tech. And that makes a lot of sense. First of all, semiconductors have been the leading sector for quite some time now. And in terms of any kind of talk of recession, whether the Fed manages to prevent that from happening, which is doubtful because it's measured by unemployment and GDP, we have to say that in the cyclical economy or in a growth economy, the first thing that goes is toys, tech toys. Are you going to upgrade to your new iPhone? Are you going to buy any fancy tech equipment when you're trying to figure out how do you pay your bills? And that's why we're seeing this reflected here. So not only did this fail to clear the 50 and the 200, but closed below it. You can see where momentum was starting to gain as of yesterday. It started to decline. In terms of price, it was outperforming the SPY by a lot, now started to underperform it, at least on the near term, and the same thing with volume. If we move over here to biotech, this has been one of the stronger sectors, but again, it's good to look at this in all ways. First of all, this is the only sector of the modern family that actually is in a bullish phase, which means that the price is above the 200 and the 50 is above the 200. So that's a good sign. In terms of momentum, look at that. We're just now starting to clear these moving averages, so this could actually also get going. It actually underperformed the SPY, though, a little bit in price, and basically was flat with it in terms of volume. So again, this you want to watch for further declines or see if it can play some catch up, and this you want to see if the momentum continues. There may be opportunity here, especially if we start to see this flip back up to show that it's outperforming the SPY. And then finally, in the modern family, here we have the regional banks. I had mentioned to you last week that this is the rural banks and very much tied into oil. So of course, we also have an oil market that's been extremely volatile, rumor driven by whether or not there's going to be any kind of cuts. They announced some cuts today, but with the lack of demand, considering how globally the world is shut down, it didn't seem to do enough, so the oil market went up and then it went back down. However, regional banks actually did pretty good, all things considered. First of all, it took out that inside week I was telling you all about, which was over 35. If we look at the momentum, looks very similar to what I showed you with the other sectors, IWM and IYT, getting into some resistance here in terms of the momentum. It actually also outperformed the SPY a little bit by price and a lot by volume. So what we can see in the economic modern family was that what the Fed did, whether you agree with it or not, actually really helped the market, and more importantly, with their coming in and buying junk, has really helped the modern family. The question is going to be whether or not that can continue, and that's where these real motion indicators and the momentum, if it starts going back down, will show that not so much. Okay, let's move on here. So now I would like to talk with you about the next thing. I have been a big proponent, and I know I'm not alone in this, in really predicting what could happen with going from the deflationary aspects of the economy right now, heading towards stagflation, and then potentially hyperinflation. I've been all over this for months now, and now more and more people are starting to talk about it, economists and some big hedge fund people, because it seems obvious that with all this money that's being printed, and all the money that's being thrown to try to save companies that may not be able to be saved, that the dollar could actually wind up going down, and with everything else happening, this could actually turn out to be extremely inflationary. So let's take a look at the key charts there. I have 6 charts here, all that reflect different aspects of potential inflation. Well, we know that gold which we have been long for quite some time, did very well today. It didn't do as well as, say, the IWM, but it did close higher than the price you see here. It closed up at around 158.68. So in terms of futures, we actually have cleared the 1700. What's going to happen now is that we're going to have to see the ETF catch up, which has a basket, of course. And once this clears, say, 160, or the futures hold the 1700, there's no reason why this thing can't fly. So that's one thing to look at. The other interesting thing here was that when I mentioned to you last week is when silver begins not only to catch up to gold in terms of performance, but actually starts to outperform, which right now, of course, you can see where this is in a bullish phase. This is still in a bearish phase on a weekly chart, that is. But what we saw today was a nice big move up, and when you talk about a V bottom, this is sort of classic right here. We really didn't get anything after an inside week, much in the way of digestion, and now, of course, we took that out. So the next level we'll be watching for very carefully is what happens around 1550. Now this here is the DXY, so this is the continuous contract dollar, and again, has been in a bullish phase. However, considering that last week the big story was that the Fed was allowing foreign countries to buy dollars in exchange for not buying debt, we didn't hear as much about that this week. So what's happening right now is essentially we've got an interesting range with the dollar. It's either going to break down under this 50-week moving average and I believe go south, and otherwise it's going to have to get back over, say, 101, which has kind of been the resistance, in which case then it'll go back north. And that will be a big influence on what happens, not just with the gold and silver, but with some of these agricultural and soft commodities. So now let's move down here. I used to trade sugar. In fact, the very first trade I ever made on the commodities exchange when I was down there was in the sugar. And sugar in 1979 was going up just as much as gold and silver was. In fact, sugar in the mid-70s, the last time we actually saw stagflation, had gone up even higher. At that point, we traded all the way up to about 60 cents a pound. And then back in 1979, 1980, traded up to about 40 cents a pound, while gold and silver were making new all-time highs. And there's plenty of reasons why sugar is an interesting and secret inflation indicator. The biggest reason is that, yes, there's environmental factors, and right now it's under pressure also because it is used for ethanol, and of course with the oversupply of oil, there isn't been much use for the ethanol. But if that flips, if in any way, shape, or form sugar starts to move up, I would take that as an interesting sign. We made a new all-time low, and now we're sitting here just inside the week from the week before. So I would say right now we'd be looking for some kind of move, say over 11 cents, and then maybe that could get interesting. Here is your oil market. To me, the most interesting thing about the oil market is if you look at this whole pattern, this is an inside week to last week. So what we really want to see now is a move over 6. If this moves over 6, not only would that be good, obviously, for people who are holding oil, it may help the actual overall market, although right now the market is so manipulated by the Fed, it doesn't really seem to matter. But more importantly, it also will maybe make the case more for an inflationary environment going forward. And then finally, I talked about this with you last week, which is the DBA. And that's the ETF for the agricultural funds. So right now, this too has been lagging, also made a new all-time low earlier in the week, closed again within the range of last week. This is corn, wheat, live cattle, which went down a lot today, which is one of the reasons why this declined. If this starts to come back up and closes a week out over 14, that would be another interesting sign. So it's very good to take a look at not only what's happening in the equities, the Modern Family with the rotation. Can that inside of the market truly be helped to actually overcome what could be tremendous damage from the virus, or is it going to be just a sort of a blip as we saw, and things are going to go back to a decline because the momentum slows down, and of course what happens with the commodities. Now the last we also looked at last week is the value versus growth. So Last week, we mentioned that the value was underperforming growth and that was an important indication because it meant that typically in the bottom of a bear market, you start to see the value buyers coming back in. So we have a couple of charts here. This one right here is the actual value chart itself on a daily basis. You can see again, bearish phase. Looks like it could head up to maybe 103 if things stay good, and then we'll have to see what happens from there. Just like what I showed you with the inside of the economic modern family, reflecting an increase in momentum but coming into resistance. So once again, we're going to want to watch what happens here. And then it started right here to outperform a little bit on the ratio of the SPY. So something else for us to keep an eye on is, does value begin to catch up in momentum and also relative to its performance in SPY? This here is growth. Growth also is about to enter into a death cross, really rallying right close to resistance here. Same thing, momentum, stronger obviously than value, but still into resistance here. And look what happens. Growth actually started to underperform SPY in the last couple of days. And then if we look down here, this is how value is related to growth itself. And right now, the good sign is that value looks like it started to at least clear in terms of the ratio to growth. And of course, we want to see that that's very near term. This is a much shorter term moving average. The test will be, of course, as we get into the higher moving averages up here. So the question really becomes now, at this point, in order for us to really be bullish, it means we have to trust the Fed. We have to trust the government. We have to trust Putin in terms of whether or not he's really going to cut more oil. And we also have to look at it versus the reality of what the damage is going to be from the virus. At this point, the virus itself is a factor, but what's really going to be a factor is how long does it have to be until we actually can really assess the damage from a longer term. In China, Wuhan, which actually reopened this week at 80% capacity, and that's mainly because the rest of the world cannot trade with them. It took them 17 weeks from shutdown to get going. So if we use the same formula for the United States, we shut down, say, middle of March. If you count 17 weeks, we're actually looking at close to the end of June, beginning of July. So the question is how many more file for unemployment? How many of those loans wind up going bust and can't pay it back? How much more can the Fed throw out there before we actually get into an inflationary environment? And of course, what happens if all of this changes long before the 17 weeks and we start to see that momentum? So what could possibly go wrong in this scenario? What you're looking at right here is a chart of the Nikkei. And yes, this is a StockCharts chart. So this goes back from 1970 to the present. Nikkei actually, or Japan, peaked in 1989. Here we are over 30 years later. And we still haven't gotten anywhere near that peak at 40,000. In fact, right now, it's closed at around 19,000. So they did exactly what the United States is doing now. The government came in, bought up all the debt, tried to support the system in terms of the high growth companies, started with all different types of stimulus, started buying equities, and they still have not been able to get back to peak. Are we going to become the next Japan? That remains to be seen. But again, I know that's a lot to cover, but these are the questions that I ask myself every single day. And of course, just really to make it super simple, all I really feel at this point is just watching that momentum in the modern family and then watching what happens with the dollar and some of these agricultural commodities along with the metals, which are already flying, will really give us our plan for the balance of 2020 and into 2021. Last slide I want to show you here is the VIX. Okay, so we have two charts here. We have the cash VIX on the bottom, and then we have the VXX, the ETF, on the top. This is also key, considering how much the market moved today and how much the LQDs, that high grade, moved, look at what the VIX did. It went down, but it's still very much holding. If you take a look first at the cash, this is the 50-day moving average, comes in at about that 40 level right here. If the market continues to go up, you can see that 40 was really where we started to move up here in February, but then once this took out 40, that's when we had that blast all the way up here to about 85, and we've gone straight down since. So that 40 is going to be an extremely key level. And if it breaks down under 40, then maybe we'll see more, and we'll see all those other indicators I showed you, momentum flip, ratios flip, IWM to play more catch up, IYT to get some kind of a bid and more volume coming in and start outperforming the SPY. But if this doesn't and starts to go the other way, that'll be something to watch for. If we look at VXX, that too is holding 40. 39.50 was actually the low a week ago. And I think 50, of course, is going to be a key area, but we can even start just based on the last several days of trading, looking at 45. So the last part of the picture for you all is going to be what happens here with the VIX. Still showing fear in the market, even though what happened. Is that going to be legitimate or not? This is going to be a very interesting week coming up next week, and I absolutely can't wait to come back next Friday and tell you exactly what happened and show you how it reflects on the charts and what we can look forward to. If I had to make a guess of what we're going to see next week, the Fed has made a commitment to not let this economy die. The question is going to be, will we become Japan, or will we set a new model and it will actually work, and this will be enough money to get us through potentially till the end of the June, July, when people start getting back to work and the damage maybe not be as great as what a lot of people anticipate. That's the $64,000 question, guys. So with that, I want to thank you all so much for watching. Keep those comments coming. I'm happy to answer them. Again, thank you to the StockCharts team. Thank to all of you for watching. Have a wonderful holiday weekend. And that's it for now. Bye for now.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.